Welcome to Beers with Rich. I'm Rich, editor of Under the Radar Report. It's great to be back. This week's Beers is brought to you by the Czech Republic and the good burgers of Five Dock. And guess what? We're celebrating. First, there was a 70% spike in one of our tips last month, Integrated Research. Here's to you boys at Integrated. Well done. Then, just after that, another technology specialist we tipped exploded, Gentrack. Raised 45% and is up 56% on where we tipped it in June. To Gentrack, the takeout, value, value, value. The takeout, value, value, value. Yep, you heard me the first time, you heard me the second time. Both these stocks were bombed out, massively bombed out when we rated them spec buys. Have a look at the charts, you'll see, left for dead. Well, that makes them interesting to us. What happens when you're patient and you look for stocks that have been aggressively sold down but have good fundamentals? You get these kind of opportunities when the fair weather players have given up the ghost. You get them when you're under the radar. Don't get me wrong, we don't get them all right. But let me tell you, the big wins far outweigh the losses. And that's the advantage of being a value investor. And you won't get that from simply surfing the trends. Again, the key to value is cash. And I've emphasized that before, I'll emphasize it again. A strong balance sheet's a good start, but it's by no means the end of the story. Basically, you've got to have a strong balance sheet, you've got to have funding ability. But the market quickly looks through this if they don't get a line of sight to positive operating cash flow. It's not easy to find this kind of stock, but there's more now than I've seen for a while. And if it was easy, it wouldn't be interesting. And we love it. That's what we love. This week's new stock ticks the boxes. It's got heavy cash reserves, cash flow positive. There aren't many quality, I can tell you this from experience, there are not many quality gold producers in the small cap arena. So this week's stock is well worth, at the very least, looking at. But what I like about it is it's got a broad portfolio of assets. So that, to me, says diversification. It's not reliant on one mine. And it's also got options on growth. Like it's developing a big asset outside of its producing assets. So while it's making that cash, you've got potential for other assets to take their place in the future, because mining's not inexhaustible, which is why I want to get on to this week's blue chip, because that's what the subject is. It's mining. So Philip Lowe, interesting guy, and I'll just say that we look at one of his recent speeches, but it's not the apology. It's not the apology, the RBA governor's apology. So forget about that. This one's much more interesting. It explains why commodities should be stronger for longer. So immediately, my ears pricked up when I read this speech. So read the issue, because I explain it in detail in the blue chip. But basically, our terms of trade's at record levels. And this was, at similar levels, maybe not as high as it is now, but 10 to 12 years ago. But back then, 10 to 12 years ago, you had a supply side response. So basically the BHPs and Rio Tintos of this world went hard, really hard investing and in exploration and in development. This time, we're not seeing that supply side response. There's a good graphic in the issue which really sums this up. The terms of trade with against mining investment, relating to percentages of GDP. But basically, why is this not happening? Why isn't there the big mining investment? Well, firstly, they got burned big time, the BHPs, the Marius Kloppers, the Albanese's. It's not Anthony Albanese, don't worry about that. It's Tom Albanese, or I think that's his name. He was in charge of Rio Tinto. But basically, back then, they were like Pac-Man strategy. They were buying everything. It was like and they almost exploded the company. Certainly in Rio Tinto's case, when it bought, I think it was Alcan, basically they almost exploded the company. So Now they're very much focused on giving back to shareholders, mainly in the form of dividends. I'm not that aware of buybacks, but mainly in the form of dividends. So they're risk averse, which means they're more shareholder friendly. But also there's the added factor that because governments are going for net zero emissions, a lot of investing has dried up for things like coal, mostly for coal, but also even for oil. For the brownfield oil projects, just are thin on the ground. So basically, there's been a lack of investment, and that's not possible ad infinitum. There's a cost to that, i.e., volumes in the future. But like BHP bought Oz Minerals, so they are looking at the future. But to me, it shows why existing producers, both small cap and large cap, are worth having a look at. So what's coming up? Like I've been saying, we're rolling out the new stocks, having a great time getting our hands dirty, analysing companies. The results are on the board. Not all winners, but the ones that have been, it's really working. The results are there. Be a part of it. So the beer, it's not bad. Psychedelic. They're probably trying to channel the Duchy of Bohemia. But actually, the word Pilsner comes from Pizen, which is a village where they somewhere in the Czech Republic. I think it's on the eastern side, where they invented the world's first blonde lager, Pilsner Urquell, and it's still produced. So here's to our valuable beers with rich watchers in the Czech Republic. A toast to you. We could do a beers with rich pilgrimage actually, and that could be part of our global brewery search tour. Stay tuned.